World Economic Outlook, published biannually by IMF staff with interim updates, offers analysis and forecasts of global economic conditions in the short and medium term, supporting the IMF's monitoring of member nations and highlighting important global economic trends, and it has just released its January update. In the latest update released today, themed Resilient Growth as Technology and Adaptability Offset Trade Policy Headwinds, the IMF sees higher global growth at 3.3% for 2026 and 3.2% for 2027, mainly due to stronger growth in the US and China, corporate resilience resulting in reduced impact of tariffs, and the AI-driven boom. US IT investment also at an all-time high. Global inflation was expected to fall, with US inflation returning to target more gradually. IMF see key downside risks, including reevaluation of technology expectations and escalation of geopolitical tensions.
Global activity continues to show notable resilience despite significant trade disruptions and heightened uncertainty. According to our latest projections, global growth will hold steady at 3.3% this year, an upward revision of 0.2 percentage points compared to our October estimates, with most of the improvements accounted for by the United States and China. We have repeatedly revised our projections upwards since April of last year. Remarkably, global growth for 2025 and 2026 is expected to be stronger than projected back in October 2024, before the tariff disruptions started, as the global economy shakes off the immediate impact of the tariff shock. This resilience reflects offsetting forces. The trade tensions constitute a major source of instability, as events of the last few days illustrated, but other factors helped. Great agility of the private sector, which kept supply chains smoothly functioning, supportive financial conditions amid a tech AI investment boom, and stronger stimulus in some countries, especially China and Germany. Now, global inflation will continue to decrease from 4.1% in 2025 to 3.8% this year and 3.4% in 2027, even if it remains above central bank targets for many advanced, emerging, and developing economies this year. Despite this, risks remain tilted to the downside, and let me mention a few areas of concern. First, growth is concentrated in a few sectors, especially in information technology and artificial intelligence.
Hello, this is Global Business Insights, where we bring thoughts and ideas to help you interpret trends and navigate the context from a business perspective. President Trump has announced a plan to raise tariffs on European allies, starting with a 10% tariff on imports from Denmark, Norway, Sweden, France, Germany, the Netherlands, Finland, and Great Britain beginning February 1. If no deal to buy Greenland is reached, the tariff will increase to 25% on June 1. Trump insists he wants ownership of Greenland, which belongs to Denmark. French President Macron may ask the European Union to activate its anti-coercion instrument, limiting US access to the single market. Ireland's Prime Minister, however, has said that while EU retaliation is possible if US tariffs over Greenland proceed, it's too early to consider using the anti-coercion instrument. These tensions are the biggest challenge facing NATO and could undermine its future. Analysts also interpret Trump's threat to impose tariffs on NATO allies over Greenland as a sign of a potential collapse of the transatlantic alliance, which could provide greater geopolitical leverage to Eastern powers. Meanwhile, US Treasury Secretary Scott Bessent stated that the United States will not retreat from its intention to take over Greenland, arguing that Europe lacks the strength to guarantee the region's security. He also mentioned that the president is using strategic leverage to achieve his goals and believes that true security cannot be achieved unless Greenland becomes part of the US. Additionally, Besant rejected suggestions that such a move by the US would mean the end of the North Atlantic Treaty Alliance. To other news, the Securities and Exchange Commission of Nigeria has substantially increased capital requirements across the securities industry. The minimum benchmark for brokers has been tripled and heightened thresholds have been set for underwriters, exchanges, and fund managers. This regulatory action aims to enhance financial sector resilience, addressing concerns regarding undercapitalized firms and aligning with recent banking sector reforms. The updated regulations take immediate effect, with full compliance required by June 30, 2027. Firms that do not comply risk suspension or license revocation, though transition plans may be considered on a case-by-case basis. According to industry analysts, these significantly increases the capital, of course, that these companies need to have, and is expected to catalyze consolidation within the sector through mergers, acquisitions, or license downgrades, resulting in a more streamlined but financially robust market. The changes aim to ensure that surviving regulated entities possess the capacity to absorb shocks and fulfill their obligations. Although the adjustment has long been anticipated in line with wider economic reforms, the scale and timeline for compliance are more ambitious than previously expected. Nonetheless, some stakeholders have raised concerns regarding potential reductions in competition due to firm exits or consolidations, the possibility of short-term credit tightening as firms prioritize compliance, and increased operational costs and complexity. There are also apprehensions about elevating systemic risks if firms cannot raise the necessary capital expediently, which could affect both innovation and market accessibility. Despite these challenges, the prevailing consensus is that the long-term objectives of market resilience, investor protection, and stability warrant the enhanced capital requirements. Many consider the regulatory development to be a positive step forward for the Nigerian capital market. It has been suggested, however, that the current 18-month compliance window ending June 2027 might be insufficient. Some propose extending the transition period to allow for a more orderly and less disruptive adjustment process. Analysts have also emphasized the vital need for operators capable of leveraging increased capital responsibly to foster economic growth rather than solely boost their profitability. Questions remain regarding the necessity for certain operators, such as issuing houses or agent stockbrokers, to meet the capital thresholds, while consolidation may remove weaker participants. Excessive capital reserves beyond operational needs reduces return on capital. It could hinder productivity and crowds out resources from other critical job-intensive sectors. The development also underscores the importance of proactive engagement between market participants and regulators in shaping significant legislative reforms. David Adeoye leads Quartus Economics, an Africa-focused economic research and publications outfit, and is an experienced economist, strategy consultant, and deal advisor. He comments on the new capitalization rules.
This is the first major change in capital requirements over the past 10 years, i.e. between 2015 and 2026. Much of the past 10 years has been marked by certain dynamics in the economic environment. First, the period was a period of slow economic growth. We had the Nigerian economy expand at less than 4%, almost consistently until 2025. Now, secondly, there has been a massive erosion of the currency's value. We've seen the naira move from 168, 193 naira to 168, 197 naira to a dollar in 2015, 2016, down to a value of 1,480 naira to a dollar, which we have today. Also, we've seen a quadrupling of the market capitalization of the Nigerian Stock Exchange from 25 trillion naira to a dollar in 2015 to more than 100 trillion naira in 2026 January. So in light of this, it's clear to see why operators in the capital markets will require additional capital. Let's start with stockbroking firms. So for the brokers, they are required to move from 200 million to 600 million naira. Now, this is for those who only hold the broker license. And this is a change of times 3. Then we have the dealers who are moving from 100 million to 1 billion naira. Then we have the broker dealers who are moving from 300 million naira to 2 billion naira, which is times 6.7. Now, for asset management firms, any firm managing above 100 billion naira is required to hold at least 0.1% of its asset under management. We have other requirements for digital asset operators, which include exchanges and custodians, tokenization platforms and intermediaries, and robo-advisors. That's those who provide financial advisors with the use of robotics. In the first place, it's important to see that operators who play in the capital markets or who work in the capital markets, they sit somewhere between pure professional services firms and financial services providers. So the work is knowledge work, but it also has to do with funds, with people's investments. So when we look at it from this angle, one area that is crucial is talent. Then we have to look at is that what does capital do for these firms? First, it provides operational stability or agility. It also provides absorbers for shocks. Capital also helps these firms to cover risk-taking activities. And ultimately, all of these go on to protect investors. Now, with these new capital requirements, what are the likely consequences? So, number one, we are having more financially capable or stable market operators. Number two, what we can expect will be a shakeout of weak or undercapitalized firms. And number three, we'll be seeing a possible consolidation among operators in the same or similar lines of capital market activities.
Elon Musk is asking for up to $134 billion from OpenAI and Microsoft, claiming he is entitled to profits they earned from his early involvement. According to a federal court filing, OpenAI benefited by $65 to $109.4 billion and Microsoft by $13 to $25 billion from Musk's contributions since 2015. Top officials from the European Union and Mercosur, the South American trade bloc, signed a free trade deal in Paraguay on Saturday after 25 years of talks. This agreement, set to become the EU's largest trade pact, aims to reduce tariffs and increase trade between the regions. It still needs approval from the European Parliament and ratification by the legislatures of Argentina, Brazil, Paraguay, and Uruguay. The World Economic Forum's annual meeting in Davos commences this week, with participation anticipated from over 60 heads of state, including President Donald Trump. Asia-Pacific markets mostly subdued as investors assess Greenland developments and the latest data coming out of China. Well, that's it on this special edition of Global Business Insights. This is Bode Oshosami. Thanks for watching. Bye-bye.